I have to say, President Trump, in my view, is taking a very smart approach. I think he's looking at 2025 as the year that, all bets are off. There can be market dislocation. He doesn't really care. He's going to do what it takes to get our, trade aligned with other nations. And I think he's, my personal view is he's right. I don't agree with him on a whole bunch of things, but on that, I do agree with him. So I think his approach is going to be 2025, let's slug it out. He wants to get everything, well positioned for a great 2026 for the midterms.
All right, so let's talk about what's coming down the pike, because we're literally 6 months till 2026.
Yeah.
So if it is kind of this, it feels like the summer doldrums. It feels calm. I know that there are deadlines coming our way with tariffs in July and then in August. How do you position right now? And you as as someone who is managing huge amounts of money, and then for someone like me, who's a do-it-yourself kind of person and doesn't have huge amounts of money?
Well, look, my view is to take a long-term view. It's really that simple. The magic of compounding is a wonderful thing. So if you can do it in a tax-efficient way, even better. But, when I look at the markets, I've been in both worlds, meaning the public markets and the private markets. I spent 10 years at Payne Weber, 86 to 96, and in 96, had the job of a lifetime. I moved into private equity, and I've been in private equity now for 29 years. So 39 years, in the public markets and private markets. And, when I look at relative value, the private markets just look a whole lot better to me. Even after giving effect to your comment about the hedge fund guys getting 2 and 20, the best private equity managers are also getting 2 and 20, but they're worth it. And I look at relative value when the market is, not just at an all-time high in an absolute basis, but from a PE perspective, we're way above the mean. And I look at the private markets and I say, look, there's still some great opportunities, particularly if you can be selective with managers.
So let's talk about private markets, because how does someone like me take advantage of the return? You have to have a longer term outlook, do you not, if you go into private markets? And quite frankly, I don't know if I have I would like, well, Dad's 93, so I probably have a 30-year outlook going ahead, but knock wood. But how do I gain access to that? Do I need an intermediary? And I, by the way, just so you know, I would use someone like you because I don't know what I'm doing out there, but I would like the opportunity to have access to that. How does that play out?
Well, first of all, your dad is a great case in point. You are probably an even better great case in point with the following perspective. The average 50-year-old today is going to live 3.5 years longer than a 50-year-old of 30 years ago. And a 40-year-old is going to live close to 5 years longer. So people are just living longer. And when you think about matching assets and liabilities, you have to start thinking about that relative trade-off between illiquidity and better returns, because nothing is free in life. But if you have a long-term investment horizon, think about the money you're going to need in your 70s, 80s, and even 90s. If you're in your 50s, stocking money away, some percentage in a private investments makes all the sense in the world. Now, you're not going to put your, all of your capital, but 10, 20, 30% of your capital, if you're a 50-year-old, if that's your long-term money, it should be in private investments. That is the place to be. So the way I've always thought about it is there's two distinct buckets. There's the hedge fund world, and then there's the private investment world. And when you think about hedge funds, what are those guys really doing? They're going out and they're making bets on public markets. And the trade-off for them is they've got liquidity, but they have no control. Private markets are just the opposite. The investor has control. And when I say the investor, I'm typically talking about a GP sponsor. They have control, but they don't have liquidity. So the private markets, think of companies. They could be early stage companies, which are typically venture capital investments, riskier. So you want to be, in a very diversified pool or portfolio of those investments. You also have traditional, back in the day, we used to call them leverage buyouts. They're sort of euphemistically today called private equity. But those are investing in, mid-sized companies, large companies that happen to be private. And therein lies, I think, the best opportunity. But when I think about privates and what Axxes Capital is doing, is we're offering private investments on the equity side. So think, as you said, venture capital or traditional co-investments in typical leverage buyouts or credit. And on the credit side, we think of direct lending. We think which is lending to companies, once again, private companies, basically taking over the role that banks traditionally played, that are taking on less and less of a role. We also think in terms of opportunistic credit. Think of special situations. The risk profile is a little bit higher, but the return profile is also higher. Traditionally, private funds have been limited to large institutions and very high net worth investors. And the rules of the game are changing. So you're seeing a wave, particularly over the past, 3 or 4 years, of what are called the interval funds. These are registered vehicles. So you're registered with the SEC. Mm-hmm. You fall under what's called the Investment Company of 1940, the 40 Act. And you can invest as little as $25,000, and you have periodic liquidity. Now, I want to make it very clear, it's not as liquid as a money market fund or even a mutual fund. So you are paying a price. You're going to be tying up your money, but there is an element of liquidity, and you can dollar cost average with $25,000 initially, put in $5,000 a month for the next however many months. Mm-hmm. It has some of the characteristics of mutual funds and some of the characteristics of those long-term primary funds that large institutional investors are in. So I think you sort of get the best of both worlds.
And if you were to do this, let's say we use your model of 25,000, do you have to be, I think, what is the SEC term for this, the qualified investor, or is it wide open to people?
Very good question. So think about it this way. Historically, you had to be what's called a qualified purchaser. You had to have 5 million or more of investable assets to be able to invest in a standard private equity or private credit fund. And the minimum investments were typically much larger than 25,000. What's interesting is these new interval funds that are coming out, and there's probably about 100 of them now, and they're growing pretty rapidly because of the investor interest. But you need only be an accredited investor. And as an accredited investor, the threshold is much lower, $1 million of investable assets, mm-hmm. or there's an income test. So you either have, sufficient $1 million in investable capital, or you make $250,000 a year for each of the last 2 years. So doctors and lawyers and relatively successful people, not multi-millionaires, but the average successful man or woman can start deploying assets in a very thoughtful way in a private investment.
And no investment. In my day job, I point out, and we reject certain paid content that we try to partner with when they make promises of returns, because one, that's illegal. You can't promise the return. But we point that out to the clients, and they're like, nope, we're rejecting that. But it's legitimate to ask, what kind of return should I be expecting? So if I do this 25,000 with the dollar cost averaging, 5,000 a month for, let's say, the first year, what's my time horizon? Are we talking 3, 5, 10? And what is the legitimate, realistic expectation?
Well, I personally would suggest those assets that are earmarked for retirement, and I'm going to presume that for typical person, retirement is at least 10 years out. That the allocation should be 10, 20, 30% of your overall assets, no more than that, mm-hmm. And certainly earmarked for the long term. In terms of expected returns, the way I like to think about it is I want to get paid for the illiquidity. So when I think of equity, I'm thinking 300 to 500 basis points, or 3 to 5% more than the public markets. When I think of private credit, I'm thinking 1 to 3%, 100 to 300 basis points, versus what I can get in public debt. And those incremental returns compounded over 10, 20 years results in a massive differential.
People say they're willing to be long-term, but my guess is that most people really don't have a longer than a 2-year horizon in investing.
Well, it's very interesting. I deal with a lot of financial advisors, both personally and professionally. And look, the job of the financial advisor is, steady the nerves of their clients. And you have to be a mid to long-term investor. I mean, short-term trading is a sucker's game, I believe. I mean, I've tried it for years. You have to think medium to long-term. Otherwise, you shouldn't be in the game. If you need liquidity in 6 months, you should not be in the stock market. It's really that simple.
But getting back to that question I asked you about return, if I can get, we're going to have a 30-year auction, we're going to have a 10-year auction tomorrow, and our next guest we're going to be talking about bonds. But let me ask you this. If my risk-free return on a 10-year, forget that inflation's going to wipe me out, but it is roughly 5%, how much better, if I go with what you're suggesting, is my return going to be?
Well, look, once again, with all the appropriate disclaimers, if the risk-free is X, I want to be making, I want to look at what corporate credits are earning above the risk-free rate. So let's just say, by way of example, that's another 2.5%. So you're at 7.5%.
Okay.
If we're not looking at, call it 9 to 10.5% returns, I wouldn't be in private investments. The good news is there are a whole host of opportunities in the interval fund space and in the private credit markets in general, where you can generate those returns.
All right. So let me ask you this. What are the most difficult questions you get from your clients right now? Because we have, we still haven't resolved the tariff situation. We don't know what's going to really happen with China. They're promising to sell us rare earth minerals for 6 months. Talk about having some leverage. How do you, I realize you got to have the cash and be able to survive more than 6 months, but how do you steady their nerves through a period like this?
Well, look, I happen to believe we're going to be going into a golden age in the United States. We are reshoring a lot of our manufacturing. We're really creating a Western Hemisphere trading bloc. We've got most of the world ready to cut deals with us. The reality is, international trade is not something the United States is nearly as dependent upon as, for example, the Chinese are. So we're in a great negotiating position. That's my view in general. My view is, we get to 26 and the market's going to be fine. I really believe that. So I'm happy to live with the short-term volatility. If there's a pullback, that's great news. We are going to be getting interest rate cuts. I think we'll get 2 of them this year. Powell's going to be out in May. I mean, I think he's the walking dead as far as Trump is concerned. So you're going to get a very, pro-Trump chairman in, for sure.
It's going to be Warsh, with the Estee Lauder's son-in-law.
There you go. So the bottom line is, a condition, and I hate to call it a condition, but it will be a condition for the next guy to get appointed, whoever it is, man or woman. They're going to be promising Trump, interest rate cuts. Pure and simple. It's going to happen. That happens in May of next year. Lo and behold, the elections are 6 months later. So I think it's going to be a very interesting time next year.
We get those interest rate cuts in 2026, and you're already predicting a really strong year for markets in 2026. Don't we just ignite inflation? Don't we? I mean, you're in ground zero of. It's not a real estate bubble because there's definitely demand. An article in the Miami Herald, or as my grandmother would say, the Miami Herald, and she was from New York. Go figure.
Well, she really is a local.
Yeah, but God bless her. No longer with us, but. They had in the Miami Herald, 50% of the people in South Florida can't afford South Florida. You drop interest rates, housing prices aren't going to come down; they're going to go up. So it sounds like almost a recipe for disaster in some of the healthiest economies in the country right now.
Well, we're in a bit of a bubble down here, which, by the way, I fully expect to continue because the demand for real estate in South Florida is not just driven by domestic demand. We're seeing demand out of Latin America, and I know, Adam, you lived here for a long time, so the influence of Latin American buyers here. But it's also coming from the Middle East. It's coming from Europe. It's coming from the West Coast of the United States. So I don't see that letting up anytime soon.